Hello, I'm Tony Kaye. I'm the editor of InvestSMART. Welcome to today's Advisor Q&A session. Today I'm joined, as usual, by Max Newnham and Bruce Brammall, financial advisors. So welcome here, gentlemen.
Thanks, Tony.
Thank you.
Well, happy new financial year.
Thank you. Thank you.
Hope it was good for you. It was certainly eventful in the lead up to the end of financial year, wasn't it?
It's the year of the leech this year. It's dedicated to the tax office.
Yeah,
Definitely.
It's a very different year this year. It's going to be for particularly for superannuation. So
yeah, there was so much going on and so many questions before the end of the financial year in terms of superannuation, pensions, tax, capital gains tax. So we wanted to talk today about the super morning after, I've called it, which is really, we've hit July 1 now, into the new financial year. The rules have changed. What do people need to be thinking about now in terms of their estate planning, superannuation, getting the right structures in place? We're just operating under a new set of rules, I suppose.
The interesting thing as a result of the new rules, although the new system started on the 1st of July, the real work now in dealing with those changes starts from the 1st of July and doesn't finish in making sure that all of the new limits and those other parts of the legislation that came in are worked through now, because it's not until the accounts for each SMSF is finalised, which more than likely in most cases can't be after October. So now the work really starts to work on making sure that no one ends up breaching the $1.6 million pension limit.
Yeah, absolutely, and hopefully people got as much done as was required before June 30 or the end of June 30, but now is really the time to start planning ahead under the new system. So as usual, we've got questions from subscribers. I invite people listening to this broadcast to go onto the website and to send in any questions they have. We'll try to get to as many questions as we can, as usual. Any questions that we can't get to today, we'll take on board, and I'll probably direct those to Max or maybe some to Bruce as well to answer in their columns over the next week or two. So keep that in mind. Also, as usual, we can't give specific advice, but we can provide general advice. So keep that in mind when asking your questions. All right, so we'll get straight to it. Got quite a few questions on board, and I'll start them off. I printed these ones off. This is from one of our subscribers. I have been receiving a transition to retirement pension up to June 30. I turned 65 in February and I'm still working. Can I convert that transition to retirement to an account-based pension and continue working, or do I have to retire first?
Did they say they turned 65 in February?
Turned 65 in February.
It might be February next year, Max, which I think would be the issue. So if it's 65 next year, in February you've got this period of 8 months where you're technically your TTR is going to be taxed. So there's a couple of options there. One of the options is to turn off the TTR, potentially stop taking a pension from the TTR until such time as you turn 65. If you have enough money outside to last you through for that 8 months, then fine, and that'll allow you to not pay any tax for that 8 month period. Then when it comes around to your birthday, turning 65 in February next year, then turn the pension back on. It will, because you've turned 65, automatically be an ABP or an account-based pension, and in which case it'll remain tax-free, and turning the fund back on. Pension account will be tax-free, and the money received will be tax-free. The other thing to think about there, though, is if they need the money or they need some of the income. If they can turn off the income, great, and do that, that's fine. If they do need some of the income, though, from the fund, one thing they might want to look at is, have they qualified during post turning 60? Did they change jobs after turning 60? Now, if you have changed jobs after turning 60, then that will be the trigger. I've spoken to a number of APRA regulated funds in the last few months, and they've said yes, all we need is proof that an employment situation finished, proof of that, which might be a resignation letter or a redundancy payout or something like that. If you can go back and prove that, at age 62, so in this case 2 years ago, at age 62 changed jobs, therefore they will look at it and turn it into an ABP as of now. So there's that option as well. But this is if the question asked turn 65 last February gone, then there's no problem anyway. It's automatically an account-based pension and won't be taxed from here on in. But so we're making the assumption there that they're talking about turning 65 February next year.
Yeah, it's something that the tax office came out recently. Previously they'd had a bit of an opinion that there needed to be the old TTR pension ceased and then a new ABB pension started, but they've changed that view, and the mere fact that someone turns 65 effectively rechristens that TTR to an account-based pension. And in the end, because the TTR pension is going to be taxable like it was going to be in accumulation, as to whether they need to turn it off, they need to speak to their accountant, see if they're going to be able to draw the minimum, and that helps them through the situation. They're not going to be any worse off by keeping the TTR pension, because if they cease the TTR pension and put it back into accumulation, it's going to end up being taxable anyway. So it's something they really need to speak to their accountant to work through what's going to work best for them.
Okay. Thanks for that. They did say turn 65, so...
they had turned, yeah.
I think
so,
we can
so effectively,
assume that.
they could say, they don't need to, but from February 2017, they have been on an account-based pension. And they'll just need to make sure, unfortunately, sometimes even accountants and the SMSF processing houses don't get it quite right. They just need to make sure that they check that whoever's doing their work has confirmed that, yes, you are on an account-based pension from July 1, which is what they should have been.
Yep.
So if it's a self-managed super fund, get in touch with the accountant and make sure it's there. If it's an APRA regulated fund, so all other super funds, then get in touch with the fund and just make sure that they have changed the fund to recognise that it's now an ABP.
In fact, that's a very good point, because if they're with an APRA fund, Bruce's strategy of ceasing the TTR pension could be a lot better for them, because a lot of the APRA funds, especially the industry funds, their fee for if you're in pension phase is a lot higher, and it can be a percentage depending on what's in there. So it could make sense if they're with an APRA fund to cease the TTR pension, so they cut their costs that are coming out. They'll still have the same tax coming out of their income, but they'll reduce their costs. And that's why it's important to speak to an advisor even on that point.
Yep.
All right, we'll get on to the next question. This one's from Craig. Craig is aged 45. He's looking at selling his business for $450,000 and making non-concessional contributions into his fund. So Craig asks around the capital gains tax exemptions. If you're under 55, you need to pay the exempt amount into a super fund or retirement savings account. Could you please advise if the $500,000 CGT exemption limit still applies after the recent changes? Also, is the exemption in any way linked to the new $100,000 per year NCC limit?
No. Craig really needs to speak to an advisor that knows SMSFs, knows small business and knows the income tax side of things, because to say he's selling it for $450 does not necessarily mean that that is the capital gain. If he started the business from scratch, he's getting $450, well, therefore it is the gain. Now, the other thing you have to drill down, unfortunately, is he operating as a sole trader, partnership or company? And in each of those different situations, there are different tax principles that will apply. But from a point of view, if we're talking about as a sole trader or through a trust, not a company, because companies really disadvantage people in a lot of cases when the small business capital gains tax concessions apply, is that if operating as an individual or through a family trust or as a partnership, the $450, they must claim the general discount of 50%. So if it was a $450 gain, that automatically brings back to $225. if the aim of the game is to get as much money into super and not so much keep money outside, rather than claiming the small business active asset discount, which is the next level of the small business benefits and capital gains tax concessions, that does not have to be claimed. So therefore, if the aim is to maximise the super going in, and because the small business CGT exempt contributions have no relationship to the 100,000, the idea would be to only claim the 50% general exemption. The 225 could then go into super, and then if Craig wanted to maximise the money in super, 100,000 from that 250, or so 225, could go into super in this year as well. So if the aim is to maximise, 325 could be going into superannuation for Craig within the next, before the 30th of June.
Well, potentially plus some pull forward. So
yeah, there's the pull forward too.
Yeah, so another couple of 100,000 potentially on that.
Yeah.
But you really need to speak to your accountants on that one to talk about the CGT and tax exemptions for small businesses who are selling assets, or selling the business. There a lot of tax planning required in that department.
Okay. Next question's from Gillian. It's also around capital gains tax in relation to the 1.6 million cap, as we've previously discussed. Julian wants to know, by resetting the cost base of certain assets, she understands future capital gains tax on their sale after 12 months will be based on the reset cost base. However, when the cost base is reset, I understand this also generates a notional capital gains tax payment which may be deferred until sale. What then is the difference apart from deferring the notional capital gains tax payment? I thought the provision to reset cost bases was to prevent penalising those who hold appreciated assets who now have to transfer them back to accumulation to comply with the new super rules. Or will the capital gains tax on final sale after 12 months be calculated in a different manner?
None of the above. Unfortunately, it's a very confusing part of the concessions, and in actual fact, there's a number of concepts within those concessions that have been mixed together, and unfortunately the answer or the impression there is not quite right. The first thing is, if the capital gains tax concession is applied for, that resets the cost base as at their value when, in most cases, it's going to be the 30th of June. Now, you don't have to hold that asset for another 12 months to be able to have that benefit. All it means is if the cost base is reset at the 30th of June at their market value, you will not get the 1/3 discount on any increase in the value from the June 30 date to when you sell it. So any increase after to June 30 will be taxable at 15%. If the assets that are revalued at June 30 held for another 12 months, then effectively the tax rate is paid 10%. So there's that sort of important clarification. The other thing is, if the segregation method is used, there is no notional income tax payable. If the, I'm having a seniors moment here, where you have to get the actuarials, the proportional method, if you're using the proportional method, it's at that point where every asset that is, where the capital gains tax concession is applied for, effectively whatever the proportion of that the accumulation accounts are of the total value. In other words, if we said that the fund had one member in it that had $100,000 in accumulation, and another member was in retirement phase and they had 200,000. So 1/3 of any gain that is being applied for the concession, it ends up having a notional capital gain, and they're right that you can get the choice to pay the tax on that gain for the 17 year or delay it until the asset is sold. So there's it's the sort of thing where before taking any action, again, they have to speak to their advisor, because it is a bit of a minefield there. There are so many different components of that.
But it does. This question kicks off the work that Max was referring to earlier, in needing to decide what assets you're going to going to apply CGT relief for and what assets you're not going to. If you've got, to take the example that was popping in my head as we were going through the answer to that was, if this person had bought an asset many years ago for $2 and on 30 June was worth $10, if you choose to reset the cost base, the new cost base is $10. So it's the gains from there that may or may not be taxed, depending on whether it's in pension and what proportion falls in or out of the pension. But for the next 12 months, if you do sell that asset, then yeah, you miss out on it. So if you sell it on January 1, so 6 months into it for $12, it's appreciated another 20%. You sell it on January 1, 2018 for $12, there is then a $2 gain rather than a $10 gain, going back to the original purchase price, a $2 gain on which some tax may need to be paid. And if a portion is sitting in accumulation. But you need to wait for the full 12 months in order to get the one-third discount again. So it would need to be sold after 30 June 2018 in order to be able to do that. If that was then done for $12 or $13 or something like that, then that's where you're looking at those potential taxation, CGT taxation. So people are going to have to work through, I know we've said it a number of times, Max, but people are going to have to go through asset by asset in their super fund to decide whether or not they want to apply for the CGT relief on that particular asset. They might have 15 shares in their portfolio and they might want CGT relief on 12 of them, and the other 3 they might not. But you don't just say yes or no that you will to your whole portfolio or none of your portfolio. It really needs to be worked out line by line, asset by asset, when you're going through and looking at the CGT relief.
In fact, the process needs to be to first of all work out what is the excess that a person's pension balance exceeds the 1.6 million. Let's say if that's 500,000, then the next part of the process is to look at the investments that the super fund has. And because you can only apply it to whole assets, like if someone's got a share where it's worth the 600,000 and it has $400,000 worth of capital gain in it, there is nothing stopping them to end up commuting $600,000 worth of their pension account, transferring that back to the accumulation account and claiming the capital gains tax exemption on that. And so you cannot claim capital gains tax exemptions more than what your excess is going to be just to gain a tax advantage, which is one of the big overriders that the legislation says it has to be to meet the new $1.6 million pension cap. The thing is, though, is that if you have assets in there that have increased in value, it will make a lot of sense to maximise your CGT concessions, and I can see no downside to that.
This seems to be a big question mark for a lot of people, actually, because the next question largely relates to the same thing from Daniel. Daniel was saying, in relation to the accumulation and pension phase in the current financial year, capital gains tax relief, if I have $2 million in a fund, transfer 400,000 of CBA shares, taking advantage of CGT relief. The original cost base $40 a share at June 30, market value. New cost base $80 a share. That's a big jump there. But so the CBA shares, all in accumulation phase, earn $20,000 of income, while the 1.6 million pension assets earn income of $70,000. Total income in the fund, $90,000. I read a lot about an actuary needed to split the income percentages over fiscal year 17-18. Why is this needed? Isn't the assets and accumulation income split from pension assets earning their own income? And in my example, above $20,000 taxed at 15%, $70,000 tax-free in the pension mode. Should I sell my CBA shares in 2 years' time, or and is the CGT $20 a share? I'm just having trouble following this question.
I think I got the question. It's a new rule number 1, Bruce, that in this case, the law is the law. As a part of the introduction of the new system, if you have more than $1.6 million in your superannuation fund as a member, you cannot use the segregation method. So yes, it is unjust. Yes, in this case, the dividends that may have come through from the CBA are the lion's share, and that you would like to try and end up having that purely related to the accumulation account. But from July 1, the law is if you've got more than $1.6 million, the fund can no longer be segregated. And use the other example before, if after July 1 there are 2/3 of the fund that have pension accounts and the rest is in accumulation being 1/3, you look at the total income of the fund, and 1/3 of that income is effectively allocated in very simple terms to accumulation accounts, and that's it. So it's back to rule number 1.
Pretty straightforward.
And just in regards to there's a question there about do I sell the CBA assets in 2 years? Max and I, you can't answer that question without looking at somebody's situation. That's talking about the specific advice that can't be given unfortunately in a forum such as this. It'll depend on whether that's the right asset to sell or what at the time of when it comes time to sell an asset, whether that's the right asset to sell.
All right. Next question's from Eugene. It's on recontribution strategies. So Eugene's saying if he's under the 1.6 cap, can he pull money out and then recontribute at the 3-year pull forward rule, 300,000? So pull out 300,000, put back in 300,000 to balance out his...
Have we got Eugene's age by any chance?
No.
No, okay. Well, withdrawal and recontribution strategy is still going to be a pretty useful strategy going forward. Let's just assume, for the sake of this, that there's $1 million sitting in the fund. It's less than the 1.6, and let's assume that it's all taxable. If you want to be changing the makeup of that $1 million for estate planning purposes, if you've got adult children that are likely to receive this money, then being able to pull out money from your super fund or your pension fund and being able to recontribute it is a strategy that you need to sit down and look through with somebody, depending on your age, depending on whether you can get the money back into super. You need to be able to do all those things. If you're over 65, you still need to meet the work test in order to be able to get the money in. If you're under that, then there's the possibility of being able to do it to have an impact on the ultimate taxable and tax-free portions of your superannuation, which will have an impact on your on what adult children or non-financial dependents will pick up and pay tax on your death. But it's more information needed, but you need to sit down with somebody to start working through it. But yeah, withdrawal and recontribution strategy is still pretty good.
As a general principle, if you assume that the person is under 65, that they've met a condition of release so that they can get their money out, the recontribution strategy works very well. If they're under 65 and they don't have a problem with the pension transfer balance cap, they could be getting up to 400,000 out, say in June of a financial year, have 100,000 go in June, and then in July 300,000, as long as they haven't exceeded their bring forward rule and things like this. So that's still available. Interestingly enough, the recontribution strategy is still available if they have the $1.6 million. So going back to if we've got someone at the 30th of June 2017, they've got $1.6 million. They're under 65, they have met a condition of release, so they can get what they like out of it. There will be nothing stopping them in June 2018 commuting $300,000 of their pension, and a commutation decreases the pension transfer balance account by the amount of the commutation, which means that would go down to 1.3, and then the 300,000 could be then recontributed in July 2018 and that immediately recreates it as tax-free. So recontribution still applies depending on a person's personal situation, even if they have met or are over the 1.6 million limit.
Good point, Max. Next question is, my wife and I are both in pension phase and trustees of their own fund. My wife's balance is 1.75 million and the shares equity has grown up to 345,000 as an unrealised capital gain. If my wife commutes 150,000 to accumulation phase and we claim capital gains tax relief, would that apply to our shares in the pension fund? If this is so, we could reduce our unrealised capital gains. What's the taxation significance of the unrealised capital gains in case of the death of a member of the fund?
The only amount that the concession can be claimed on is the amount that needs to be transferred back from a pension account to an accumulation account. So that's the only way that the concession can be claimed. But as I said before, if in this case, I think the wife has 1.75 million, that's right. So we've got 150,000 excess. If there were two shares that there are, or three shares, or whatever it was, if you look at the shares and work out what shares has the highest capital gain, and it could be that three shares might come up to 140,000 and there ends up being a fourth share that's worth 60,000, and that is decided to end up being commuted back to accumulation phase. That means $200,000 worth of shares will be able to have the CGT concession claimed on it. Once the CGT concession is claimed, the cost base is reset. So whether a member dies or not doesn't have a great deal of effect on this. It just means that the cost base is reset to that, and then if they're sold later on for a higher price, they're only paying the capital gain on the difference between the reset cost base and what they sell it for. But interestingly enough, when I said before there's no downside to the resetting of the cost base, is if for some reason those shares fall, what will be created in that super fund is a capital loss that can be used to offset against other capital gains at a time where you're in a fund where a portion of the capital gain is going to be taxable because of the proportional method. So I can see no downside from doing that.
All right, thanks Max for that. Next question is from Rob. Rob's looking to make a bring forward non-concessional contribution of 300,000 in this financial year, which will bring him to just under $1.6 million total. If my fund earnings before the NCC payment result in the 300,000, bringing the total above 1.6 million at June 30 next year, is that a problem? I've assumed employer contributions and concessional contributions totaling 25,000 are separate to the NCC.
So the rule that's being talked about here is that once you've hit $1.6 million, you can't make any further non-concessional contributions. So what the government has said, what the ATO government, the ruling has said, is that prior to that, prior to the 1.6 million, you are restricted as to how much you put in. So if you're between 1.5 and 1.6, you can use $100,000 payment. Even if you're close to the 1.6 million mark, you can still do it. It's going to put you over, but if you're putting it in and you're under, that's fine. Between 1.5 and 1.4, you can use you can do the 100,000 plus 1 year of the pull forward, so 200,000 in total. Between 1.4 and 1.3, you can still do the 300,000. Sorry, below 1.4, essentially, you can do $300,000 or the full 3 years of catch up. So I don't actually know, Max, as to what point they make the you have to sort of decide or determine what the fund is valued at. It's
always the
30th of June, I would assume.
Yeah.
So if he's under the 1.6 or one, he's saying at the moment essentially he's under 1.3, so let's call it 1.275. And if we're saying that's the value on 30 June, then he is able to make we believe, the $300,000 during this financial year, even if in the meantime $25,000 in concessional contributions plus some growth has taken him over the 1.3, ignoring the 300,000 for a little bit that he wants to put in. So if the 25,000 in concessional contributions plus a bit of growth were to take him over that during the course of this year, we're saying that because it was 1.275 on 30 June, he's able to put in the 300. That's my understanding, and yours as well. Yeah.
If the aim is to maximise the amount that's going to go into superannuation in, let's say, 14 months, the thing would be to assess what the superannuation fund is doing between now and, say, June 2018. If the $100,000 that is going in would effectively put the members' balance over 1.4, and let's say they're wanting to maximise it, it would make sense that if putting the 100,000 would mean that they would go up to, say, 1.41 million, it would make sense only putting 80,000 in, which means they're below the magic 1.4, and then that would mean, all things being equal and the calculations are correct, they could put another $300,000 in July 2018 because their balance at June 18 will be 1,380,000 or something like this after the 80,000 has gone in, and then they would be able to use the bring forward rule in July of another 300,000 going in.
Think in that example 200.
No, they're still under 1.4.
Okay, all right.
So if they're under 1.4,
1.4 to 1.5, you can do 200.
So what I'm saying is the 80,000 goes in, the balance goes to 1.38.
Yes,
So they're below the 1.4, then they can put the 300,000. But again, you need to get the advice on from someone who knows what they're doing from that point of view.
Yeah, it's all very important, obviously, to tally up your numbers very carefully to make sure you don't get over that limit.
In fact, the new system is going to require a greater ability to process information on a more regular basis, especially for people who are wanting to maximise their contributions and what have you. But the other thing is that under the new reporting requirements, if someone's going to be stopping a pension or starting a pension, there's the requirement now, I think, that within 28 days of the end of the quarter, the tax office has to be advised in the approved form. That is what's going to apply from effectively 1 July 18, because there is this concession that these new stricter reporting requirements, they're calling them real-time reporting requirements, that will apply equally to SMSFs as they do to big APRA funds. For this, there is a year of phase in where the reporting requirements in relation to pensions started and stopped and commutations for this 2018 year, they can be advised when the 2017 tax returns lodge. So there's going to be a greater need to keep a track of where your super fund is, so that you'll be able to work out whether you can make these sorts of things like the concessional contributions if you're getting close to 1.4 or 1.5 or 1.6.
Yeah, absolutely, because you wouldn't want to jump over the limit unexpectedly.
That's it.
Yeah. Next question's from Andrew. It's also around the CGT relief. Essentially what Andrew wants to know is the stock market, as we know, dipped on June 30 this year. So Andrew wants to know, are the values reset at June 30, close of business, or do you use the start of business on June 30? Can it be any time on June 30 or just close of business?
The June 30 share prices are the publicised June 30 prices, which would be close of business.
Close of business. Yeah, that's what I would have thought as well.
I'm not sure where the advantage in that case would be from taking the opening value.
Talking minimal, unless you had a share that tripled in price or halved in price from the opening bell to the... So
yeah, we know the market went down by about 1% or so on June 30, so pretty marginal in most cases. Moving on to some other online questions here from Eric. Will the 1.6 million cap be applied every year, forcing an adjustment if one looks likely to exceed the cap, or is it a one-off?
No, it's a question that's been asked pretty much every day since the 1.6 was first raised. You only have to get under the 1.6 million once if you are a brilliant investor and you manage to turn your 1.6 into $3 million or $4 million or $5 million over time, even after you're taking your pension, then that's fine. You don't have to constantly transfer money back to super. The 1.6 million is a starting figure for transfer balance cap. If you're a particularly successful investor and you are able to get returns of 20 or 30% a year, all power to you. The government is fine with that. You're just going to have to take an ever-increasing a pension on an ever-increasing amount of money. So the pension that you'll have to pay out will increase each year.
Okay, good, Bruce. Next question is from Kaz. Kaz wants to know, in regards to the age limits and work status in making non-concessional contributions and the 300,000 pull forward rule, is it a requirement to pass the work test in a financial year to allow you to use the pull forward rule for the 300,000?
No.
No.
Because the work rule only applies to people who are 65 or older, and once you're 65 or older, you can only ever contribute a maximum of 100,000. So that was a short, sharp, succinct. So yeah.
Sorry, the question asked in this case was 59. Is
No,
that
65.
65.
Well,
Post
65.
65.
So post 65, you can only ever use 1 year, and you need to meet the work test. If you meet the work test in July, it covers you for that financial year. So you can make the contribution at a point during that financial year, but again, only up until you turn 74. Once you turn 75, then no further contributions can be made to super regardless of the work test.
Is my memory serving me right that you are still able to, in your 65th year, put in the 300,000?
Yeah,
So,
yes.
so as long as you
Yeah.
meet the work test. So if someone turns 65 during a year, let's say they
you're
turn
64 on July 1,
they're 65
basically.
on July 1. If you're turning 65 in February, you could be putting the 300,000 in without worrying about a work test before February. If you don't have the ability to get the funds to be able to make the $300,000 contribution till May, for that financial year, because you'll be making the contribution after you turn 65, you will need to have passed the work test. So it's, again, one of those areas where there are some transitional situations where just because you turn 65 doesn't stop you putting in the 300,000. There are a few other parameters and a few other things that need to be looked at to see whether the 300,000 can be contributed.
Okay, thanks, Max. Next one's from Tom. Tom's short one. Do tax-deferred distributions influence the estimated cost base as at June 30, 2017?
Estimated deferred?
Estimated cost base.
So the tax-deferred...
Tax-deferred distributions.
Property trusts.
It just ends up, any tax-deferred distribution received means that the fund or even individuals don't pay tax on that income they get. But the value of the deferred tax distribution decreases the purchase price. So, as an interesting sideline, that if people are going to be wanting to take money, or they're over the 1.6 limit, they have no taxable income other than what they were getting through their superannuation pension, and we've got the 3 bucket rule, it makes sense that the money will come out of the superannuation sector into their individual names, and therefore investing in these sorts of property trusts could also have a double benefit, because they may be actually getting income of more than $25,000 a year, but because of the tax deferred, they're still not paying any tax on it. Again, they're going to need to speak to an advisor. So the tax deferred amount, all it ever really does is increase the capital gain made on that investment.
Okay, thanks very much, Max. Next one is from Fred. Fred has only just moved into pension mode as of June 30 this year. Got their own SMSF, and so it's already set up with the pension and accumulation accounts, according to Fred. So he wants to know, in terms of commuting cash from the accumulation element, will that essentially leave the 1.6 million in the pension account untouched? I'm assuming it would.
I'm struggling a little bit with the question there, but
That's why I looked at you.
I can read it again.
Read it again. Read it again.
Okay, so I'll read it.
So he just turned on a
directly.
pension on 30 June.
Just turned on the pension.
And is looking to pull some of the money out
Yes.
of the superannuation system to get into personal name.
From the accumulation account. Will that reduce the element in the accumulation account but leave the 1.6 million pension cap untouched?
Yes and no. No, the situation is, and it's a somewhat confused question. If they've just started a pension on the 30th of June, whatever the value of that pension at the 30th of June will count towards the pension cap. If that's $1.6 million and they had previously $2 million sitting in their accumulation account, they'll end up with a $1.6 million pension account and a $400,000 accumulation account. If they're wanting to take money outside of super and they're in that situation, rather than taking out of accumulation, they would want to, and let's say they want 200,000 out. They want to put it on, Tatsalato's got the big bonus $50 million win, and they thought that'd be a good return. So 200,000 would come out as a commutation of the $1.6 million pension to go into their personal hands, which would then enable them to then transfer 200,000 of their 400,000 accumulation account into their pension account, because the 200,000 commutation would have reduced their pension transfer balance account down to 1.4. Then they could. So again, they need a good advice on this.
But I think, Max, you've still got the 1.6 million tax-free in pension. This is the three buckets strategy that we're talking about. So if you leave the 1.6 mil in pension and there's this 400,000 sitting outside, that $400,000 is paying tax at 15%. If you pull that if they're saying there's no other assets, I think we were saying, or you were suggesting, no other assets in their personal name, that $400,000 is being taxed at 15% at the moment. If they've got no other assets in their personal name, that second bucket is that amount of money that you've got outside. Now, if you pull the 400 out and put it in your personal name, this is assuming no other income-producing assets there, that $400,000 earning 3% a year is $12,000 a year. There'll be no tax paid on that $12,000 if that's the only other income as well. So I think that's probably where the question is coming from. Rather than commuting a portion of the pension, is potentially pulling that money outside to use that second bucket. The 1.6 million is tax-free. The second tax-free bucket is when you're earning up to, depending on your age, up to 20,500 or 27 or 30, depending on couple status and whatever. But having that income being earned outside super, if you're under those thresholds and there's no tax to be paid on that income, and in that case, if we're pulling that 400 out there, there's nothing left in superannuation phase, so there's no tax being paid there. So that's where turning that $2 million, 1.6, 400 sitting outside, zero in superannuation accumulation, there's no tax being paid on any of those assets, so long as it's staying under the tax-free threshold there. Is what I was thinking of. Commuting it is potentially another strategy, but that's one where you could use the three-pot strategy, or use two of the three pots in this case, to have $2 million worth of assets on which no income tax is being paid.
All right, thanks very much, Bruce. Question from Greg, which is our last question at the moment. So if you do have any further questions before we wrap up today, please send them in now. Otherwise, I'll wrap up and I'll just talk to Bruce and Max about some general estate planning strategies for this financial year. But last question from Greg, a short one as well. Greg just wants to know, he's already at the 1.6 million balance. Can he make the concessional contribution of 25,000?
Yes, concessional contributions are not affected at all by the value of a person's superannuation. So you can have, it could be someone that's had $5 million in their super fund at the 30th of June in pension. There's 3.4 gone back to accumulation and they've got 1.6 in their pension account. There is nothing stopping them to be making concessional. It can either be employer contributions, salary sacrifice contributions, or personal tax deductible contributions. So there has no effect on the ability to do that. Obviously, if they're over 65, they've got to meet the work test to be able to make the concessional contribution. But that's, yeah.
And that 1.6 million cap only really comes into play at retirement when the pension and accumulation accounts need to be set up.
The 1.6 million applies on whether someone's in retirement or not. If you've got a 42-year-old who's been able to sock a lot of money into superannuation, and their pension and their superannuation accumulation balance is now 2.2 million, they can't make any more non-concessional contributions. So the only thing that they can make is concessional, and there's no correlation or no effect on what can be made other than the contribution limit on what can be made as concessional contributions.
I wrote a piece about this for anybody who's watching the webinar now, sort of a slightly whimsical piece on this, which probably got published yesterday, and that is how to build, under the new rules, the biggest possible super fund that you can. And that comes down to, it would start with, and it's only the likes of the Packers, of the Lowies and the Triggerboffs, their children potentially, who are going to be able to do this. But you start putting in your $100,000 from age 18, and you put in 300,000 using the pull forward at 18, then another 300 at 21, another 300 at 24, and then by the time you get to and you're putting in your $25,000 each year during that period as well. At about age 27, you're going to hit roughly $1.6 million in super. So at that point, you can no longer put any further non-concessionals in. But you can continue to put in your $25,000 a year from that age 27, or whenever you go over the 1.6 through until the age of 65. So you can actually build, if we were using a certain growth rate in there and whatever else, but we're talking about building a $9.3 million super fund is still possible, much higher if you can get better growth rates than I was using for that piece. But that's the way that's going to be, that people, the wealthy might be able to do that in the future. And that's sort of notionally the biggest super fund that can be created. But the point of the piece was that the ability to put in non-concessional contributions completely ceases once you hit 1.6 million in super. It's done. It's over. But after that time, so long as you can. So long as you're under 65, you can continue to make the concessional contributions, and between 65 and 74, if you meet the work test, you can do the concessional contributions as well.
Yep. And Greg just sent in a follow-up to his question, pretty much that point. Can he still contribute 25,000 as a concessional? I think we've answered that. Yep. Well, that brings the questions to an end. So I just wanted to wrap up today's forum, really just talking about, from your own perspectives, what are some of the key things that people should be looking at generally as a strategy under the new super rules?
One of the things that I had a bit of an epiphany about was when the new rules came in, I thought that the reversionary pension could be dead and no longer a benefit because of the effect it would have on someone possibly going over the 1.6 million. In fact, the way the new rules are going to work, to create less work and administration in relation to your superannuation administrator for your SMSF, reversionary pensions can actually create a lot more certainty, because when someone dies, if it's not a reversionary pension, the trustees, which inevitably will be the remaining member of the couple, they have the choice of paying a lump sum out of superannuation of the deceased member's balance, and that would be accumulation and pension. They can start a death benefit pension from the balance, or a combination of both. Now, when a reversionary pension occurs, the reversionary pension automatically reverts to the reversionary pension of the spouse, the partner, and so therefore it's an automatic situation. For a death benefit pension, the value that is counted, and we've got this new thing called the transfer balance account, that we have to stay under the 1.6, and it's when the amounts are recorded in that is the critical part. When a death benefit pension is started, it's the date of the death benefit pension. With a reversionary pension, the credit or the increase in the value of what you are, is counted towards your pension transfer balance account is made is 12 months after the date of death. So therefore, giving that 12 months delay means that we know exactly what the value of the pension is because it's the date of death, and then the reversionary pension gives the person, the surviving member of the couple, time to work out what is the best way to do it. Do I have all of the reversionary pension and keep that? And if that would put them over the 1.6 million limit, do I take it all, and therefore commute some of my account-based pension, or do I commute some of the reversionary pension and have to pay it out? But it does create a bit of time, and so reversionary pensions certainly are not dead and buried. They can provide the time for someone to make up their mind. I mean, the interesting thing is when a death occurs, the requirement is that the members' benefits must be paid out within a reasonable length of time. There's nothing in statute, but in most cases the tax law would say up to about 6 months. We'll give you 6 months to work out what's going to happen with that person's superannuation as to whether it's staying in super if it's able to as a death benefit pension or it's going out. A reversionary pension gives that person
extra time.
That 12 months.
Yeah, that's a good point to make.
And I'd probably say that one of the big things, and this is talking about a different age group, and that is that people in their 30s and 40s are going to have to start planning more for their superannuation than is done previously. So if you're in your 30s or 40s now, your parents' generation had the ability to literally shovel money into superannuation, $100,000 a year per job, going back pre-2007. Then there was a period of 100,000, then 50,000, then 25, then 30, then and 35 for recent years. It is now harder to get money into superannuation than it has ever been before. And what this is going to have the biggest impact on is people under the age of 50 who are going to have had for the majority of their life, their working life, a maximum of $25,000, short period of $30,000 that they could get into super. People are going to have to make the sacrifice earlier to get a little bit more into super from an earlier age. And I think this is going back now to sort of probably about their mid-30s or so, because at the time when previous generations have been able to do it in their 50s, when the mortgage is paid down, the kids are off their hand, or the private school fees are finished, they were able to shovel money into super at up to $100,000 a year. When this generation, my generation, the 10, 15 years younger than me, any future generations, gets into their 50s and have met that time in your life where mortgage is down, kids are off your hands, private school fees are finished, and you're ready to shovel money to super, you can't. You're going to be at a maximum of $25,000. Now, depending on your income and whatever else, the salary sacrifice, you might be able to do $40 or $50 or $60 or $70,000. You're not going to be able to anymore. So the planning that's going to be required for the under 50s is that you're going to need to start thinking about it sooner. Yep. At age 35, 38, something like that, putting in an extra $100 a week, $5,000 a year into super. Yes, that's not going to be used to pay down your home loan. Yes, that's not going to be there to be able to pay school fees or whatever, but it's a sacrifice earlier in life that's going to need to be made, because when you get to that point in your 50s, you're just not going to be able to do it in the same way that generations older than us have been able to do. I think that's a really important thing, that a lot of the focus has been on the 1.6 and the non-concessional contributions, and that's very important for that generation. But for a younger generation, then need to be thinking more about, well, how do I get more money into super earlier?
Yeah, and I can't but support that. In fact, there's some other factors in this too, because if you think about it, $100 a week, $5,200. If the person is on, let's say, they're on a good salary and they're earning $200,000 a year, they're under the $250,000, I think, where the extra 15% superannuation, Division 3A, whatever it is, tax applies. when you think about it, $100 that is being sacrificed into salary, and interesting enough, it doesn't need to be salary sacrificed. Under the new rules, they could be making it as a personal contribution. So as long as they are disciplined, they could see how things are going and then whack in an amount up to it. But on $100, in actual fact, they are only missing out on about $54 after the tax and
it'll be
Medicare.
Difference between 85 and 51 or so. There's 30, 33, 34, $35 on the 100. If they put the 100 into super, they lose 15%.
Yeah. So, but
if they take it as salary,
but then I'm just saying, from a point of view of
53.
what they're missing out of their personal budget, it only ends up being about $54, and that's a couple of cafe lattes and some cream buns and something like this. So that's an important thing to consider. The other thing is where planning needs to be taken into place too, is because of the reduction down from 180 with a 3-year bring forward down to 100 with the 3-year bring forward, is also the new ability under the new system to carry forward if there have been years that someone hasn't been able to get the 25,000 in. I think it starts from the 2019 year. From the 2000, you are able to increase the amount you can sacrifice or contribute as a tax-deductible contribution. And why the planning becomes important is if you have an asset that you know you are planning to sell in several years' time, it can make sense if you keep a track of where you are at with what's being contributed, and let's say you've been contributing $10,000, there's been $10,000 a year contributed over 5 years, and in the 5th year, that would mean with the 25,000 and 4 lots of 15, you could be making something like an $80 or something thousand deductible contribution to reduce the tax payable. So yes, the real watchword is planning for your retirement, putting in place strategies that will maximise your retirement assets at the end, and assisting you by reducing tax along the way.
A good point on what Max had just said there as well, this example that he was using of $200,000. Somebody earning $200,000, if they're getting the full 9.5%, they're having $19,000 a year put into super under superannuation guarantee anyway. They only have the ability to put in $6,000 a year or more. That's a bit over $100 a week, less than $120 a week. Gets them to the $25,000. Now, if that person is 40 and earning $200,000, a very good chance that at age 45 they're going to be earning $250, $300, whatever, and any SG is they're going to be over the $25,000 limit anyway. So it's something that people need to be looking at is, well, my SG at the moment is $15,000 or $19,000. I can make that sacrifice now, particularly if my income is going to be rising for the next 5 or 10 years, because you hit a point at $250,000 where it makes less sense, and where the 9.5% is basically getting you to the $25,000, and you can't make further concessional contributions. So there's a lot of planning that needs to be done there for anybody really on more than, I think, $70,000 or $80,000 a year. You're not necessarily trying to hit the $25,000 every year, but making just smaller extra one, $20 a week, $100 a week, whatever it is, getting more into super from an early age, because it's never been harder to get money into super, and we're not going to be able to do it post 50.
It's a great message, and I think as best as possible, even our older listeners should be retelling that story down to their children. Who may be in their 20s, 30s, 40s even. That they have to really plan ahead and put the money in to be able to maximise their contributions. We'll leave it there, gentlemen. So thanks again for coming in today.
Pleasure.
It's always a pleasure to have you in. You'll join us again for our next one in August. We'll work on a topic for that, but I'm sure we'll have plenty of questions in the meantime. If you do have any questions, please always feel free to send those in, and we'll aim to address those in the columns during the ensuing month. Thanks for joining us.